Hello everybody, I'm hoping you all are doing well. In this session, I'm going to be discussing with you all some 50 important concepts which generally students tend to overlook. Let's run through them one by one. I have 50 such concepts touching upon each chapter. The video is going to be a little fast paced because it is meant to be something which you will be viewing on the day of your examination. So let's begin. Starting with the basic concepts chapter, under section 115 BBE, in case your assessee has any cash credits, unexplained incomes, unexplained investments or any such transaction for which he is not able to give any satisfactory explanation, 60% tax will apply, 25% mandatory surcharge will be applicable and 4% says effectively your assessee will be paying 78% tax. Please know that these are flat rates. You will not be allowing any expense against this income. You will not be adjusting any loss against this income. You will not be enjoying section 87A rebate against this income. Section 115 BBE, keyword no satisfactory explanation. Assessee is not able to give any satisfactory explanation. Then 60% tax, 25% mandatory surcharge and 4% says effectively 78% tax. Then what are the maximum surcharge rates? Under the normal provisions, if you see, the maximum surcharge rate is 37%. But under 115 BAC, if you see, the maximum surcharge rate is 25%. And if your assessee is having any dividend income, 111A STCG or any LTCG, whether default provisions, whether normal provisions, the maximum surcharge rate for these three incomes is going to be 15%. What are the three incomes? Dividend, LTCG and 111A STCG. Then listen, I have certain situations over here. In each of these situations, we need to see that whether we'll have to follow 115 BAC or whether we'll have to follow the normal provisions. If the question is silent, we will be following section 115 BAC. If the question says apply default provisions, we will be applying 115 BAC. If the question says normal provisions, we will not be applying 115 BAC, we will be applying the normal provisions. Regular provisions, again we will be applying the normal provisions. If the question says as per optional regime, even there we will be doing as per the normal provisions. Alright, so 3 points we're done with. Section 115 BBE, cash credits, unexplained incomes for which I'm not able to give any satisfactory explanation, 78% effective tax rate. Then we saw maximum surcharge rate under the normal regime, 37%, under 115 BAC, 25%, and for those three special incomes, which three incomes? Dividend, 111A STCG and all LTCG, for these three incomes, 15%. Please notice, this is not special rate incomes. Special rate incomes are 111A STCG, all LTCG and your casual incomes. Here I don't have casual incomes. Instead I have dividend income. Dividend, 111A STCG and all LTCG. Here the maximum surcharge rate will be 15%. Whether my assessee is following 115 BAC or not doesn't matter. In both the regimes, for these three incomes, 15% only. Alright. Then taking you to the fourth point, rebate under section 87A. Now if your assessee is following normal provisions, condition 1, assessee must be an individual. Assessee must be a resident. Resident includes both ROR as well as RNOR. Alright. And total income should not exceed 5 lakhs. I have three conditions. If all the three conditions are fulfilled, then my assessee will enjoy 87A rebate, maximum 12,500. Individual, resident, total income within 5 lakhs. However, under 115 BAC, again, assessee must be an individual, assessee must be a resident, but here the total income should not exceed 7 lakh rupees. Here the limit is 7 lakh rupees. Here the limit was 5 lakh, here it is 7 lakhs. If all these three conditions are fulfilled, then under 115 BAC, the maximum surcharge is going to be 25,000. But under 115 BAC, you have marginal rebate as well. You have marginal relief relating to rebate as well. Like for example, if the total income is 7 lakh 25,000 and for this, let's say the basic tax as per 115 BAC is 27,500. Then in that case, you will be doing three steps. Basically, even if your income is more than 7 lakh, generally you will get rebate only if income is within 7 lakh. But even if income is more than 7 lakh, you will still have relief relating to rebate. But how will you calculate? Step 1, total income minus 7 lakh. Here my total income is 7 lakh 25,000. So 7 lakh 25,000 minus 7 lakh 25,000. Then what is the tax which you calculated as per 115 BAC? The basic tax number 27,500. Now you will do step 2 minus step 1. This difference is going to become your 87A rebate. Now if this difference happens to be a negative number, then you will not have any 87A rebate. So I took the help of this example to explain the marginal relief with respect to rebate. I'm hoping you've understood. It's extremely important from the upcoming examinations point of view. Marginal relief relating to rebate, what are your steps? You will first see total income minus 7 lakhs. Then you will find out how much is the basic tax as per 115 BAC. Then step 2 minus step 1, the difference will be considered as your 87A rebate. But if this difference happens to be a negative number, then you will not have any rebate. But do you have all this calculation even in the normal regime? No. This is only in 115 BAC. Okay, even if your income is more than 7 lakh, you will still have this calculation, and generally we do this calculation till income of 7,27,000, 7,28,000, till that much income only we do this calculation. Okay. So these are your 4 points under basic concepts. Now coming to residential status and scope of total income. In residential status chapter, you will be finding total income minus income from foreign sources. This calculation you do in 2 places. Number 1, when you find the residential status of the individual, and number 2, also when you are checking for deemed resident. In both of these, you do the 15 lakh calculation. Now total income minus income from foreign sources means what? It is nothing but income from Indian sources. Now income from Indian source generally means income which is earned in India. That's all. But however, for this 15 lakh calculation alone, income from Indian sources will have totally 3 things. Number 1, incomes earned in India. Number 2, business incomes from businesses controlled in India. And number 3, professional incomes from professions set up in India. Point to be noted, I will consider income earned in India, but I will not consider incomes which are received in India. So total income minus income from foreign sources means income from Indian source. Income from Indian source generally means only one thing, which is income earned in India. But for the purpose of this 15 lakh calculation alone, income from Indian source will mean 3 things: incomes earned in India, business incomes from businesses controlled in India, professional incomes from professions which are set up in India. Then coming to the 6th concept, if your assessee is where is salary accruing? If your assessee is earning any salary, where has the salary accrued? It always depends upon the place where you render services, but there is an exception. If the employer is Government of India, if the employee happens to be an Indian citizen, even though he is rendering services outside India, still, even though the services are being rendered outside India, still salary, allowances, perquisites, everything will accrue in India. After accruing in India, the salary is going to be taxable. But after accruing in India, the allowances and perquisites will be fully exempt. So generally, salary accrues in the place where you render services. But however, there are 3 conditions because of which an exception will apply. Employer has to be Government of India. Employee has to be an Indian citizen. Even though services are rendered outside India, in this case, still salary will be deemed to accrue or arise in India. Out of these 3 conditions, if even one condition is not fulfilled, like for example, if the employee is not an Indian citizen, then this exception will not apply. If exception doesn't apply, the general rule will apply, that is salary accrues wherever you render services. Alright, then comes a deemed resident discussion. When do you think about deemed resident? If whenever the assessee happens to be a non-resident, you never close your answer over there, isn't it? If your assessee is a non-resident, you go ahead and check 4 conditions. If all these 4 conditions are fulfilled, then assessee becomes a deemed resident. If assessee becomes a deemed resident, you will treat him as if he is RNOR. Now, what are the 4 conditions? Condition number 1, assessee must be an Indian citizen, not person of Indian origin, guys, only Indian citizen. Condition 2, assessee must be a non-resident. Condition 3, total income minus income from foreign sources should be more than 15 lakhs. And condition number 4, if at all the assessee is earning income from other countries, assessee should not be liable to pay tax in any other country. 4 conditions, if all the 4 conditions are fulfilled, then your assessee will become a deemed resident. If deemed resident, you will treat him as if he is RNOR. Understood? Till here all clear? 7 points we've completed already. Now come on, let's go to our agricultural income discussion. If assessee is earning agricultural income from an agricultural land in India, it's going to be fully exempt under section 10 clause 1. But whether assessee is an ROR, whether assessee is RNOR or NR, it doesn't matter. For all assessees, agricultural income from an agricultural land in India is going to be fully exempt. Whether it is an urban agricultural land or rural agricultural land, it doesn't matter. Any agricultural income earned from an agricultural land in India is going to be exempt under section 10 clause 1. Then, however, if your assessee is having exempt agricultural income, okay, and they're asking you to pay tax, are you listening to me? Assessee is having exempt agricultural income and they're asking you to compute tax. Immediately, the partial integration method will come to your mind. Partial integration method, however, everybody knows what are the steps in partial integration method, but you never straight away start applying partial integration method. First, you check whether 3 conditions are fulfilled. Condition 1, assessee has to be individual HUF, AOP, BOY, AJP. Condition 2, the net agricultural income of the assessee should be more than 5,000. And condition number 3, the non-agricultural income should be more than basic exemption limit. Only if all these 3 conditions are fulfilled, only then you can even start partial integration method. So your method of thinking, your sequence of thinking will be like this. The question says assessee is having exempt agricultural income. You will immediately go to the last line of the question and see, are they asking you to compute tax? Whether 115 BAC, whether normal regime, it doesn't matter. If assessee has exempt agricultural income and you're computing tax, immediately the partial integration method will come to your mind. But you will never straight away start applying partial integration method. You will first check whether the three conditions are fulfilled. Only if all the three conditions are fulfilled, only then you will apply the partial integration method. Condition 1, assessee must be individual HUF, AOP, BU by AJP. Condition 2, the net agricultural income should be more than 5,000. And condition 3, the non-agricultural income should be more than the basic exemption limit. Then coming to the next point, coming to the salaries chapter now, if the employer's contribution to RPF plus superannuation fund plus NPS, three things guys put together, RPF, superannuation fund, NPS put together, if it is more than 7,50,000, you will find what is the excess. The excess will be taxable as a perquisite. On the excess, what is the interest? The interest will also be taxable as a perquisite. Then if you're talking about employees contribution to RPF and statutory provident fund, RPF and SPF, if it is more than 2,50,000, you will see what is the excess. Excess is not taxable. On the excess, what is the interest? The interest will be taxable. Alright. But however, if the employer is not making any contribution, only the employee is contributing, then instead of the 2,50,000 number, you will take the 5 lakhs number. See, these provisions are in addition to the usual provisions. Generally, what do we do with employer's contribution? Up to 12% of salary is exempt, beyond 12% excess is taxable. That is anyways there. Over and above that, we will see, is the employer's contribution to these three things put together, is it more than 7,50,000? If it is more than 7,50,000, then the excess is taxable as a perquisite. On the excess, the interest is also taxable as a perquisite. Similarly, employee's contribution, what do you generally do? ATC deduction you give me guys, that you will anyways give. In addition to that, you will check, is it more than 2,50,000? If it is more than 2,50,000, excess is not taxable. On the excess, what is the interest? The interest only will be taxable. And also, if the employer is not making a contribution, then instead of 2,50,000, you will take the 5 lakhs number. Alright, this is about your employer's contribution discussion. Then any life insurance premium, if the employer is paying for the employee, it's going to be fully taxable for the employee. Life insurance premium for the employee or his family. Who is paying? Employer is paying. For the employee, it's a benefit. It will be a taxable perquisite for the employee. However, if the employer is paying any other premium for the employee, health insurance premium, personal accident insurance policy premium, all that is going to be fully exempt. You recall guys, we've learned all this in full depth. Life insurance premium alone is going to be taxable. Any other premium, if employer is paying for the employee, it's going to be fully exempt. Then gratuity. When it comes to gratuity, assessee may be covered by POGA or assessee may not be covered by POGA. And leave salary. These three adjustments I'm trying to compare. See, in gratuity covered by POGA, you take the last run salary. You don't consider average salary. But gratuity not covered by POGA and leave salary, in these two you consider average salary guys. Now last run salary means you will take only basic salary plus all DA, whether forming part, not forming part, doesn't matter. But gratuity not covered by POGA, leave salary. In these two, you take average salary. In both of these, average salary means what? Last 10 months average. But last 10 months average, how will you compute? Gratuity and leave salary. In both of these, if you see, the salary will have three components. Basic salary plus DA forming part plus employees turnover based commission. But the point is, for gratuity, you will be taking 10 months before the month of retirement. For leave salary, you will be taking 10 months before the date of retirement. I hope you recall guys, we've worked out questions on all of these, showing the difference. I've worked out calculations for you. I'm hoping you're able to recall. Gratuity covered by POGA, last on salary. Gratuity not covered by POGA, average salary 10 months before the month of retirement. Leave salary also average salary, but 10 months before the date of retirement. For gratuity, whether covered by POGA, whether not covered by POGA, the maximum exemption that you can enjoy in your entire lifetime is 20 lakhs. For leave salary, the maximum exemption that you can enjoy in your entire lifetime is 25 lakhs. When you're computing gratuity covered by POGA, alright, any fraction if you have in the number of years, in any fraction in the number of years, what will you do? Less than 6 months, you will ignore. Equal to 6 months, you will round off to the next number. More than 6 months also, you will round off to the next number. Understanding? So when you're computing gratuity covered by POGA, here alone you will consider the fraction. Less than 6 months you will ignore, equal to 6 months also you will ignore, more than 6 months you will round off to the next number. Understanding? Up to 6 months you will ignore, more than 6 months you will round off to the next number, but only if assessee is covered by POGA. If assessee is not covered by POGA and also in leave salary, in both of these, whatever be the fraction, you always ignore the fraction. Alright, this was a good comparative analysis between gratuity and leave salary. So gratuity covered by POGA, I'll take the last on salary. Gratuity not covered by POGA and leave salary, in both of these I will take average salary. Average salary means 10 months average. Gratuity not covered by POGA, average salary will be 10 months before the month of retirement. Leave salary will be 10 months before the date of retirement. For gratuity covered by POGA and not covered by POGA, in both, the maximum exemption which you can enjoy in your entire lifetime is 20 lakhs. In leave salary, the maximum exemption which you can enjoy in your entire lifetime is 25 lakhs. For gratuity not covered by POGA, you will consider fractions. Up to 6 months you will ignore, more than 6 months you will round off to the next number. Gratuity not covered by POGA and leave salary, in both of these you will ignore the fraction. Then, according to me, this is really important from the upcoming examinations point of view, interest-free loan and loan at concessional rate of interest. Now see, if the purpose of the loan is medical treatment of Rule 3A disease, or if the aggregate original loan is up to 20,000, out of the two, if even one condition is fulfilled, then it's going to be exempt. Try to recall 7 to 8 situations we saw in this one perquisite in class. You remember, you're supposed to look at the aggregate loan and not each loan separately. You're supposed to look at the original loan and not the outstanding loan. So if the purpose is medical treatment of Rule 3A disease, or if the amount, or if the aggregate original loan amount is within 20,000, out of these two, if even one situation is applicable, then the perquisite is going to be fully exempt. And I hope you recall, if this perquisite is taxable, you will do the computation, whatever percentage you will calculate, it will be a percentage of what? It will be a percentage of the outstanding amount, not the original amount. The original amount is what you consider for this checking point. But when you're doing the computation of the taxable perquisite, you will see the percentage of what? Percentage of the outstanding amount. What will this percentage be? Do you remember? You will see what is the SBI lending rate on 1st April of the previous year minus whatever interest rate my assessee is paying. Basically, you will find the benefit which he is enjoying. That benefit will be calculated as a percentage of the outstanding amount. Okay. So if the purpose is medical treatment of Rule 3A disease, or if the aggregate original loan is within 20,000, out of these two, if even one situation is applicable, then the perquisite will be fully exempt. Then coming to the IFHP discussion, relating to IFHP, my first point is going to be about interest on borrowed capital, which is allowed under section 24. Now, if my assessee is having a self-occupied property, under normal regime, interest will be allowed, but generally it is allowed maximum 30,000 only. But if 3 conditions are fulfilled, then the maximum is 2 lakhs. The 3 conditions are: condition 1, loan should be borrowed on or after 1st April 1999. Condition 2, loan should be borrowed for purchase or construction of property. And condition number 3, the purchase or construction should be completed within 5 years from the end of the year of borrowing. So therefore, if your assessee is fulfilling all the 3 conditions, the maximum limit will be 2 lakh. If even one condition is not followed, like for example, if the loan is for repairs, or if the loan was borrowed before 1st April 1999, then the limit will be 30,000. But if it's a let-out property, entire interest is allowed as it is. There is no limit at all. But however, if your assessee is following 115 BAC, then self-occupied property interest itself is not allowed. Let-out property interest is normally fully allowed. Alright. Then interest is allowed under IFHP on accrual basis. But municipal tax is allowed on payment basis. And when I say payment basis, it has to be paid by assessee himself. Then we had also learnt about section 25. If you recall, we had learnt if assessee is paying interest outside India, and if he is a resident, and if he has a house property in India, if all these 3 conditions are fulfilled, section 25 will apply. Section 25 says, assessee, you have to deduct TDS. Only if you deduct TDS, only then interest is going to be allowed. 3 conditions, guys. Interest is being paid outside India, which means assessee borrowed loan from outside India, but assessee is a resident and even the house is situated in India. If all these 3 conditions are fulfilled, section 25 will apply. Section 25 says, assessee, you first deduct tax on the interest, only then that interest will be allowed under section 24. Alright. Then coming to your 15th concept, under IFHP, we have something called as composite rent. Under composite rent, there are 2 two situations. In situation number 1, my assessee is collecting from the tenant rent and also other charges like lift charges or annual maintenance charges or let's say electricity charges. He is collecting from the tenant not only rent but also other charges. Very simple, rent will go to IFHP, other charges will go to IFOS. But however, if the assessee is charging from the tenant rent for the house and also rent for other assets, then you will check, are the house and the assets, are they separable or are they not separable? If they are separable, for example, the house and the car, assessee has given to tenant two assets, house and car. They are separable. It is possible to let out house to one person, it is possible to let out car to another person. If they are separable, the house rent alone will come to IFHP, the car rent will go to IFOS. But if the two assets are not separable, like for example, assessee is giving a house to his tenant, along with the house he is giving attached furniture, and this furniture and the house, they are not separable, which means it is not possible to let out house to one person and furniture to another person. It is not possible. So if it is a situation like this where the house and asset are not separable, then the entire rent will go to IFOS. Now see, be careful. What do you mean by separable? Separable does not mean separate rent. Separable means, is it possible to let out one without the other? Is it possible to let out one without the other? Look at this over here. Separable means it can be let out separately. What does this mean? What this means is, like for example, if you see house and car, it is possible to let out the house to one person and the car to another person. But however, like for example, if you take an auditorium, in auditorium, tell me, is it possible to let out the property to one person and the furniture to the other person? Is it possible to let out the property to one person and the light system to another person? No. So there it becomes inseparable. It becomes something which is not separable. If it is not separable, the entire rent will go to IFOS, but obviously if it is a part of assessee's business, then of course it will come to PGBP. Understanding? So composite rent, two parts. If assessee is charging from the tenant rent and other charges, rent alone will come to IFHP, other charges will go to IFOS. If assessee is charging from the tenant rent for the property and also rent for other assets, then if they are separable means it is possible to let out one without the other. If it is separable, the house rent alone will come to IFHP, other assets will go to IFOS. But if they are not separable, the entire rent will come to IFOS or PGBP as the case may be. Now coming to the PGBP chapter, the most important adjustment according to me from the PGBP head for your examination will be section 40B, which talks about partner's interest and partner salary. Now know that first of all, section 40B will apply not only to partnership firm, it will also apply to LLP. Alright, now let's talk about interest first. Interest maximum 12% per annum will be allowed. Whether the partner is active partner, sleeping partner, doesn't matter. The maximum interest will be allowed is 12%. Whatever is allowed for the firm will be taxed for the partner. Then when we talk about salary, for the firm you will do computation of how much salary is allowed. That computation will depend upon the book profits. Now book profit up to 3 lakh, you will compute 90% of the book profits or 1,50,000, whichever is higher. On the excess book profit, you will calculate 60% of book profit. This will give you the maximum allowable salary for the firm. Whatever is allowed for the firm will be taxed for the partner. Right guys? However, be careful relating to salary. If the partner happens to be a sleeping partner, all this calculation will not apply. All this calculation applies only if the partner is a working partner. If the partner happens to be a sleeping partner, for the partnership firm, any salary they paid will be fully disallowed. For the partner, nothing will be taxable. All this calculation will apply only if the partner is an active partner. If he is an active partner, on this basis you will arrive at the maximum limit. So you will know what is allowed for the firm. Whatever is allowed for the firm, that only will be taxable for the partners. Understanding? So I want you to be very clear with this differentiation. If the partner happens to be a sleeping partner, you will not do all this calculation for the firm. If the partner is a sleeping partner, whatever salary is paid to him, that salary will be disallowed for the firm and it will not be taxable for the partner. But if he is an active partner, then you will do all this computation for the firm. Whatever is allowed for the firm, that only will be taxed for the partner. And please remember, this is the maximum limit. This is the maximum limit. Alright. But are we differentiating between active partner and sleeping partner for interest also? No. Alright. So this was about section 40B. Then coming to presumptive taxation, concept number 17. Under section 44 AD, sometimes 6% of the turnover is PGBP, sometimes 8% of the turnover is PGBP. Now when do you say 6%, when do you say 8%? You will take 6% of the turnover if you will take 6% of that turnover which has been realized in specified mode on or before 139(1) due date. Whatever turnover has been realized by the assessee within specified mode, on or before section 139(1) due date, on that turnover you will take 6%. On the entire balance turnover you will take 8%. Try to recall the flow chart which I taught you under section 44AD over here. Whatever is the turnover, you will see how much is realized within 139(1) due date in specified mode. On that turnover 6%. On the entire balance turnover, whether received, whether not received, how received, when received, I don't care. On the entire balance turnover 8%. Okay. This is going to be your PGBP, guys. But however, under section 44AD, when will section 44AD apply? Section 44AD will apply only if the turnover of the assessee is within the limit. Now, turnover limit is generally 2 crore. But however, if the cash receipts are within 5% of the turnover, I am not saying 5% of total receipts. I am saying if cash receipt is within 5% of the turnover, then the limit will become 3 crore. Otherwise, generally the limit is 2 crore. 44AD will not apply to every assessee. It will apply to only those assessees whose turnover is within 2 crore. But if cash receipts are within 5% of the turnover, then the limit will be 3 crore. Now coming to 44ADA. In 44ADA, very simple, 50% of the gross receipts will be a PGBP. Now 44ADA also will not apply to every assessee. First of all, you must be carrying on a specified profession, and secondly, from that specified profession, what are your gross receipts? Your gross receipts have to be within 50 lakhs. This is general limit. But however, if your cash receipts are within 5% of your gross receipts, then in that case, the gross receipts have to be within 75 lakhs. This is extremely important. I hope you've understood. Try to recall. Now listen, also one more thing I had taught you about this as well, that when you say cash receipts, for the purpose of 44AD, for the purpose of 44ADA, and also for 44AE, for 44AD, 44ADA and 44AB, your tax audit, for the purpose of these three sections, whenever we say cash receipts, we will include cash receipts, we will also include all those check receipts, checks other than account payee check. So cash receipt means what? It will include cash receipts. It will not include account payee check, but it will include other checks. All checks other than account payee check will also be considered as cash receipts. So this concept will apply not only to 44AD and 44ADA when you're doing this checking, it will also apply to 44AB. All clear, guys? Yes. So under 44AD and 44ADA, you have general limits of turnover and gross receipt. But you also have special limits. Special limits will apply only if cash receipt is within 5% of turnover. Cash receipt is within 5% of gross receipt. Now this cash receipt will not only include receipts in cash, it will also include all those checks which are not account payee checks. Then coming to 44AE. Under 44AE, presumptive taxation relating to those assessees who are in the business of plying, hiring, leasing goods carriages. Here, if they have heavy vehicles, you will calculate 1000 rupees per month per ton per vehicle. If assessee is having other vehicles, 7500 per month per vehicle, even a part of the month you will compute as full month over here. But however, the most special point under 44AE is that not only this, from this you are allowed to subtract one thing, section 40B. That is partner's interest and partner's salary, which is paid by the partnership firm or LLP. So if the assessee happens to be a partnership firm or LLP, then that assessee can claim section 40B as a deduction in 44AE computation. You don't have this deduction in 44AD and 44ADA. In 44AD, straight away 6% turnover, 8% of turnover, story over. 44ADA, straight away 50% of gross receipt, story over. In 44AE alone, you are allowed to avail section 40B deduction. So if the assessee happens to be a firm or an LLP, whatever interest or salary they've paid to the partners under section 40B, that also they can allow. Okay, so this was presumptive taxation. Good number of points we've spoken about over here. 6% 44AD applies for assessees who are carrying on business. 44ADA will apply to assessees who are carrying on specified professions. 44AE will apply to those assessees who are in the business of plying, hiring, leasing goods carriages. But all businesses will not come under 44AD. Only those businesses whose turnover is within 2 crore. But if cash receipt is within 5% of turnover, then the turnover limit will become 3 crore. Similarly, all specified professions will not come under 44ADA. You will come under 44ADA only if your gross receipt is within 50 lakhs. But if cash receipt is within 5% of gross receipts, then your limit will be 75 lakhs. Alright guys, this was your presumptive taxation discussion. Then coming to section 40A subsection 2, if assessee has incurred an expense and if the other party happens to be a relative and if the expense is more than FMV, if all these three conditions are fulfilled, whatever is the excess expense over and above the FMV, that is going to be disallowed. Now relative means what? If I am the assessee, it will include my brother, my sister, my lineal ascendants, my lineal descendants and my spouse. Then coming to section 43B. Section 43B talks about 6 expenses guys: tax, duty, cess or fee, employer's contributions, bonus, commission, leave salary, interests and amount that we have to pay to railways for use of railway assets. It doesn't cover all interests, it covers only those interests which we have to pay to State Finance Corporation, State Industrial Investment Corporation, NBFC, then bank and public financial institution, right guys? So there are 6 transactions which are there in section 43B. 43B says for those 6 expenses, please make the payment within 139(1) due date. Only if you make the payment within 139(1) due date, it will be allowed. If you don't make the payment within 139(1) due date, for now it will be disallowed, but later whenever you make the payment, it will be allowed again for you. This is fine, this is simple, this is straightforward. But however, if the assessee is incurring an expense and if the other party happens to be a micro entity or a small entity, medium or not, I don't care. Micro or small entity is where I care. If the assessee is incurring an expense and the other party happens to be a micro entity or a small entity, assessee, you have to make the payment not within 139(1) due date. You have to make the payment within section 15 time limit. And section 15 not of Income Tax Act, section 15 of MSMED Act 2006. So assessee, if you are incurring an expense and the other party is a micro enterprise or a small enterprise, you have to make the payment within section 15 time limit. If you make the payment within section 15 time limit, then it will be allowed for you. But if you don't make the payment within section 15 time limit, for now it will be disallowed, but later whenever you make the payment, at that time it will be allowed for you. Now section 15 is section 15 not of Income Tax Act, it is section 15 of MSMED Act. What is the section 15 time limit? Section 15 time limit, it depends upon is there a written agreement between the parties or not. If there is no written agreement, if there is a written agreement, then you will see the time limit as per the written agreement or 45 days, whichever is lesser. Alright, so section 15 time limit, if there is a written agreement, will be whatever is the time limit as per the written agreement or 45 days, whichever is lesser. But if there is no written agreement between the parties, then section 15 time limit is going to be 15 days. So if assessee makes a payment within section 15 time limit, then it's going to be allowed. If payment is made after section 15 time limit, for now it will be disallowed, but later when the payment is made, it will be allowed. Alright, then comes my next point. I'm comparing two things. I'm comparing employer's contribution to RPF and employee's contribution to RPF, not from salaries head point of view, but from the PGBP head point of view. Listen to me. When you talk about employer's contribution to RPF, 43B will apply. And 43B says make payment within 139(1) due date. But when you talk about employee's contribution to PF, two sections will apply, 224(10) and 36(1)(5)(a). So there are two transactions over here. The employee is giving his contribution to employer and employer is going to give the contribution to RPF. Two transactions guys. Employee is going to give his contribution to employer and then the employer is going to give this employee's contribution to the RPF. So instead of employee directly giving to RPF, employee is giving to employer and employer is transferring it to RPF. Now there are two transactions. As soon as the employer receives the contribution from the employee, it will be taxed for the employer under the PGBP head. But when the employer remits the employee's contribution to RPF within the not 139(1) due date, within the PF due date, then it will be allowed for the employer under 36(1)(5)(a). So there are two transactions. We are comparing two things, employer's contribution and employee's contribution. Employer's contribution, pretty straightforward. 43B will apply. Assessee, please make the payment within 139(1) due date, only then allowed. But employee's contribution, which employee is giving to employer and later employer will remit to RPF. As soon as employer receives it from employee, it will be taxed under the head PGBP. Later when the employer remits it to the RPF within the PF due date, then it will be allowed for the employer. Alright guys. Then there is a bonus point over here relating to 43B. Whenever you convert, see 43B includes interest, right? And 43B also includes taxes. So when you convert unpaid interest into loan, it is not considered as payment. But when you convert unpaid GST into loan, this is considered as payment, and because it is considered as payment, this will be allowed in your PGBP computation. Alright, so these were 20 concepts. Now coming to the 21st concept, for section 40A subsection 3. Section 40A subsection 3 says, assessee, if you are making payment for an expense, if it is more than 10,000, please make the payment in specified mode. Generally the limit is 10,000. But however, if assessee is making payment for, if the assessee is making payment towards plying, hiring, leasing goods carriages, there the limit will become 35,000. And if assessee is paying retirement benefits, there the limit will be 50,000. So generally it is 10,000, but however, payment for plying, hiring, leasing goods carriages 35,000 and payment for retirement benefits 50,000. Then after this, whatever interest my assessee has incurred on loan till the asset is put to use. Let's say my assessee has bought an asset, okay, and assessee is going to put that asset to use a little later, and for this asset assessee has borrowed a loan. So whatever interest my assessee has incurred on the loan till the asset is put to use, it's going to be capitalized, that is, it will be added to the actual cost. Whatever interest my assessee has incurred after the asset is put to use, it can be debited to P&L, it will be allowed. Alright, and one bonus tip, please remember, if my assessee gets any subsidy or any grant to purchase a depreciable asset, that amount will be reduced from the actual cost. Subsidies and grants will be reduced. Alright, see, whatever expense you incur before you put the asset to use will be added to the actual cost. But however, if you get subsidy or grant to purchase the asset, the subsidy or grant will be reduced from the actual cost. Alright. Then coming to your capital gains discussion, in capital gains, the category A, the most important section here would be section 112A. 112A will apply only to long-term capital assets. They can be listed equity shares or listed units of equity-oriented mutual fund or listed units of business trust. If listed equity shares, you should have paid STT both at the time of transfer also, at the time of purchase also. Alright. So if it is long-term capital asset being listed equity shares or listed units of equity oriented fund or listed units of business trust, wherein STT is paid at the time of transfer but for shares also paid at the time of purchase, if this is a situation, 112A will apply. 112A says if LTCG is up to 1 lakh, there is no tax, but if LTCG is more than 1 lakh, I will find the excess above 1 lakh. On the excess, 10% tax will apply. 112A LTCG, no indexation, guys. Chapter 6A is not allowed against this. 87A rebate is also not allowed against this, and if you have any unutilized basic exemption limit, even that can be adjusted against 112A income, provided assessee is a resident. ROR, RNOR doesn't matter. Now, in 112A, against 112A income, if surcharge is applicable, the maximum surcharge will be 15%. In 112A, the most important calculation will be how well do you calculate the cost of acquisition. See, it all depends upon the date of acquisition. If the date of acquisition is on or before 31st Jan 18, you will apply the drama calculation or the grandfather clause, whatever you call it. If the date of acquisition is on or before 31st Jan 18. Now, how do you do this? How do you apply the grandfather clause? If the date of acquisition is on or before 31st Jan 18, you will take the actual cost of acquisition, you will compare it with FMV on 31st Jan 2018 or FVC. Out of these two numbers, whichever is lesser, out of these two numbers, whichever is higher. That's going to be your cost of acquisition, and no indexation of that cost of acquisition. Okay, but if the date of acquisition is after 31st Jan 18, you will take the actual cost of acquisition as it is, no indexation. So 112A, no indexation. Cost of acquisition computation is different. If the date of acquisition is after 31st Jan 18, you can take the actual cost as it is. But if the date of acquisition is on or before 31st Jan 18, then you will see the actual cost of acquisition. You will compare it with FMV on 31st Jan 18 or FVC, whichever is lesser, and out of these two numbers you will take whichever is higher. Okay, so this was 112A. Remember, in your entire Income Tax Act, in your entire DT syllabus at the CA inter-level, 112A is the only income where 87A rebate is not allowed. Against betting income also you can enjoy 87A rebate. Against 111A STCG also you can enjoy 87A rebate. But see, against 112A you can't enjoy. And you remember my very first concept, cash credits, unexplained income, unexplained investments, there also you cannot enjoy 87A rebate. Alright. Then coming to the next point, slump sale. This is also very important. Slump sale, the relevant period of holding will be 36 months. Indexation is not allowed over here. Cost of acquisition plus cost of improvement will be your net worth number. Net worth will be nothing but assets minus liabilities. Now, when you're computing assets, if the asset has been revalued, you will take the amount before revaluation. If it is an asset against which you have claimed 3580 deduction, for that asset you will take the value as 0. If it's a depreciable asset, you will take the WDV as per Income Tax Act and not WDV as per books of accounts. If it is any self-generated asset like self-generated goodwill, self-generated trademark, any self-generated asset, you will take its value as 0. Remember, slump sale, no indexation. Okay. Then coming to section 50C. Section 50C will apply if the capital asset is land, building or both, basically some immovable property, and STV has to be more than 110% of full value consideration. If both these conditions are fulfilled, section 50C will apply. Section 50C says actual full value consideration dustbin. Instead, I will take the STV number. The STV number will be deemed to be your full value consideration number. Now, you are supposed to take STV on which date? It's preferable to take STV on date of agreement. But you will take STV on date of agreement only if three conditions are fulfilled. Condition 1, at least some consideration buyer should have paid to the seller on or before the date of agreement in specified mode. If all these three conditions are fulfilled, you will take STV on the date of agreement. If even one condition is not fulfilled, then you will take STV on the date of registration. Okay. Now, however, if the assessee is comparing STV and FMV, then the assessing officer will appoint a valuation officer and ask him to find the FMV number. Now, you will compare STV and FMV and you will see which is lesser. If STV is lesser, you will take STV. If FMV is lesser, you will take FMV or FVC, whichever is higher. This is your whole of section 50C. Capital asset is land, building or both. Condition 1, STV is more than 110% of full value consideration. If both these conditions are fulfilled, section 50C will apply. Section 50C says whatever is the actual full value consideration, ignore. Instead, take the STV number. The STV number will be deemed to be your full value consideration number. But however, if the assessee is comparing STV with FMV, then AO will appoint a valuation officer who will find the FMV. So you will compare the STV and FMV. You will see which is lesser. If STV is lesser, take STV. If FMV is lesser, take FMV or FVC, whichever is higher. Now, you are supposed to take STV on which date? It's preferable to take STV on the date of agreement. But you can take STV on date of agreement only if some consideration buyer has paid to the seller on or before the date of agreement in specified mode. If even one condition is not fulfilled, then you will take STV on the date of registration. Alright, then coming to IFOS. Now, under IFOS, if you see, if your assessee is having any post office savings interest, like for example, assessee earned 10,500 post office savings interest. Under IFOS, how much will be taxed? From this 10,500, you will give 3,500 exemption. You will tax only the balance 7,000. Then 80 TTB later in chapter 6A, you will give deduction. How much deduction, guys? 7,000. You will give us a deduction under chapter 6A. Okay. So post office savings interest, 3,500 exemption you will get under IFOS. But also remember to enjoy 80 TTB as the case may be in chapter 6A. Then if any advance money is forfeited before 1st April 2014, it will be reduced from the cost of acquisition. You will arrive at the revised cost of acquisition. That number only you will index. But if the advance money is forfeited on or after 1st April 2014, then the entire advance money as it is will be taxed under the IFOS head. Then under section 222E, dividend I am talking to you about next. If the closely held company gives any loan to a shareholder who has at least 10% total voting power, then this loan itself will be considered as dividend under section 222E. So closely held company is giving loan to a shareholder who has at least 10% equity share capital in the company, then this loan will be considered as dividend. In the second situation, the closely held company is not giving loan to the shareholder. The closely held company is giving loan to another concern. In that concern, this shareholder is having substantial interest. Substantial interest means at least 20% interest. So even over here, this loan will be considered as dividend under 222E for the shareholder. Or if the closely held company is making any payment on behalf of such a shareholder, even this will be considered as 222E dividend. But what is the maximum limit? The maximum limit is up to accumulated profits of the company. Here I am not saying whether capitalized or not. So I will only consider the accumulated profits. I will not consider the bonus share capital. Okay. So 222E, closely held company is giving loan to a shareholder who is having at least 10% equity shares. This loan will be considered as dividend. Closely held company is giving loan to some other concern where such shareholder is having substantial interest. Substantial interest means at least 20% interest. This loan will again be considered as dividend under 222E for the shareholder. Or if the closely held company is making any other payment for the shareholder, even this payment will be considered as 222E dividend. But in all the three cases, the amount is going to be taxed as dividend for whom? For the shareholder obviously. And how much will be taxed? Only up to the accumulated profits of the company. Full stop. No, I am not saying capitalized or not. So I am only going to consider the accumulated profits. I am not going to consider the capitalized profits. I am not going to consider bonus share capital. Okay. Then coming to clubbing of income, if assessee is transferring any asset to his spouse for no consideration or for inadequate consideration, any asset other than house property, then income from such transferred asset will be clubbed. Income from transferred asset in different form will also be clubbed. Income from income you will not club. Income from transfer of the transferred asset you will club. Income from accretions you will not club. I hope you recall one big table we had made in this regard in class, right? Income from transferred asset you will club. Income from transferred asset in a different form also you will club. Income from income you will not club. Income from transfer of the transferred asset you will club. Basically, if you have any capital gains from transfer of this asset, that also you will club. Income from accretions you will not club. But this asset should not be house property. Why? What if it is house property? If assessee is giving a house property to his spouse for no consideration or for inadequate consideration, deemed donor concept under IFHP chapter will apply and not the clubbing chapter. Alright guys. But however, if assessee and spouse, if they have an agreement to live apart, that is a divorce proceeding is going on between them, neither will deemed donor concept apply nor will clubbing concept apply. Then comes my 30th concept. If assessee is transferring income to a person without transferring asset, transfer of income without transfer of asset, clubbing provisions will apply. Whether it is a revocable transfer, irrevocable transfer, doesn't matter. Whether the transfer is relative, non-relative, doesn't matter. Transfer of income without transfer of asset is equal to clubbing. Okay, then if assessee is transferring asset to another person, assessee is transferring any asset to another person, capital asset, not capital asset, whether this person is a relative, not relative, nothing matters. Point is, assessee is transferring asset to another person, but it is a revocable transfer. If it's a revocable transfer, clubbing provisions will apply. But if it is revocable only upon the transferee's death, then we will treat it as if it is irrevocable and we will not apply clubbing. However, if it is revocable upon the transferee's death, but during the transferee's lifetime, if assessee is enjoying any benefit directly or indirectly, there also we will club. Try to recall one big question in clubbing chapter we had worked out which covers this. Right? Even a small amount of benefit, even if it is indirectly, it will be clubbed. So if assessee is transferring asset to another person, if it is a revocable transfer, then we will club. If it is revocable only upon death of the transferee, we will treat it as if it is irrevocable and we will not club. But if it is revocable upon the death of the transferee, but during the transferee's lifetime, if the assessee is enjoying any benefit directly or indirectly, we will club. Okay. Then minor child's income, if it is because of skill, talent, labor, or if it is or if the minor child is suffering from ATU disability, then you will not club. All other incomes will be clubbed with that parent's income who has higher income. But against this clubbed income, you will enjoy 1032 exemption of 1500 per child. There is no limit of 2 children over here. How many ever children? 1500 per child exemption you will get. But this 1032 exemption of 1500 per child you will not get if assessee is following 115 BAC. Then relating to minor child, is one more small point I wanted to discuss with you. If assessee is giving house property to his minor child other than minor married daughter, if assessee is giving house property to his minor child for no consideration or inadequate consideration, deemed donor concept under IFHP will apply, clubbing concept will not apply. But this deemed donor concept will not apply to minor married daughter. So if minor married daughter, you will instead apply which concept? The clubbing concept you will apply. Understanding in simple words, house property plus minor child, which concept you will apply? Deemed donor concept you will apply. In deemed donor concept, do you have 1500 exemption per child and all? No. If it is same house property plus minor married daughter, then deemed donor concept will not apply. So automatically what will apply? Clubbing concept will apply, because minor child, any minor child, whether minor married daughter, whether any other minor child, clubbing concept will apply. But clubbing, so therefore you will enjoy 1500 exemption per child. But if assessee is following 115 BAC, the 1500 exemption will go away. Alright, so this was your discussion with respect to minor child's income. Minor child's income because of skill, talent, labor, you will not club. If the minor child is suffering from ATU disability, also you will not club. All other minor child's income you will club. You will enjoy 1032 exemption of 1500 per child, no limit on the number of children. But this exemption you will not get if assessee is following 115 BAC. But if assessee is giving house to his minor child for no consideration or inadequate consideration, clubbing concept you will not apply, deemed donor concept you will apply. In deemed donor, 1500 exemption you will not get, and if the minor child is minor married daughter, deemed donor concept will not apply. So welcome to clubbing. Okay, then coming to the 33rd concept, stepping into the set off and carry forward chapter. If you have any loss from house property, you can do intra-head adjustment under both regimes. You can do inter-head adjustment only in the normal regime, that to maximum 2 lakhs. You can carry forward the losses only under normal regime, that too only for 8 years. In fact, you can carry this forward even if you filed your ITR late. And you can adjust earlier years brought forward losses only in the normal regime. But whenever you are bringing forward from earlier years, you have to stay within the same head. In simple words, if assessee is following the default regime 115 BAC, you can only do intra-head adjustment of loss from house property. If you are not able to do, it will simply lapse. You cannot do inter-head, you cannot carry forward, you also cannot bring forward earlier years loss from house property. But under normal regime, you can do all 4. You can do intra-head, you can do inter-head but interhead maximum only 2 lakhs. You can carry forward for 8 years. You can also bring it forward from the last year. Then, if assessee is having specified business for which assessee is claiming 35 AD deduction, and from that business if he is suffering a loss, this loss you can adjust against income from any specified business. Whether I am claiming 35 AD or not, it doesn't matter. This loss you can carry forward indefinitely, but you can carry it forward indefinitely only if ITR is filed on time. If it is not filed on time, you cannot even carry forward, it will lapse. Okay, so if assessee is having a specified business for which he is claiming 35 AD, from this business if he has suffered any loss, this loss can be adjusted only against income from any specified business. Whether it is claiming 35 AD or not, doesn't matter. Okay. Then coming to chapter 6A, first of all I am discussing with you the most important point in chapter 6A, ATTTA and ATTTB. Rarely do we find a question paper where this is not tested. So ATTTA, ATTTB, out of these two, obviously ATTTB is more beneficial. So you will try to apply this first. Assessee has to be senior citizen or super senior citizen, and assessee is earning interest income from BCP, bank, cooperative bank or post office. This interest income can be savings account interest income, FD interest income, RD interest income, it can be any of these. So assessee is a senior citizen or super senior citizen. Assessee is earning interest income from BCP. This interest income assessee will get deduction under ATTTB, but maximum 50,000 only. However, when it comes to ATTTA, ATTTA will apply to those assessees who are individuals who are not getting covered by ATTTB, and it will also apply to HUF. ATTTB is not applicable to HUF. ATTTA is applicable to HUF. Oh yes, about HUF, one more point. Is 87A rebate applicable for HUF? No. 87A rebate is only for resident individual. Okay, coming back. So ATTTA assessee has to be an individual to whom ATTTB is not applicable, or assessee has to be a HUF. This assessee is earning interest income from BCP, but it has to be only savings interest income. It should not be FD or RD interest income. So this interest income under ATTTA assessee will get a deduction, but maximum how much? Maximum only 10,000 rupees. Maximum only 10,000 rupees. Okay. Then coming to ATJJAA. In ATJJAA, assessee has to be a person who is carrying on business. Basically, assessee is having PGBP and tax audit should be applicable to the assessee. Assessee should be having additional employees in the current year. To these additional employees, salary should be paid in specified mode. I am not saying any mode, I am not saying non-cash mode, I am saying specified mode. Under ATJJAA, under ATJJAA, you are paying salary, right? The salary should be paid in specified mode, right? That salary should not exceed 25,000 per month. Also, the employees must be participating in RPF. Also, the employee must have worked for us for at least 240 days in the previous year. But if the assessee is in seasonal establishments like apparel sector, footwear sector or leather sector, in these three sectors, I am not expecting employee will work for you for 240 days. Employee should work for you for at least 150 days. If all these conditions are fulfilled, to these additional employees, whatever salary you are paying, 30% of that you will get as a deduction across 3 years. 30%, 30%, 30% across 3 years. Now, ATJJAA is a section which you will enjoy whether assessee is following 115 BAC or normal regime. In both you will enjoy ATJJAA. However, if assessee files ITR late, then you will not get ATJJAA because ATJJAA comes under chapter 6A part C. Any chapter 6A part C section you will not get if assessee is filing ITR late. Alright, so ATJJAA is a chapter 6A part C section. Alright, so coming back to ATJJAA, 6 conditions. Assessee must be carrying on business or profession, and assessee must be having tax audit. Assessee must be having additional employees. To those additional employees, assessee must be paying salary or wages in specified mode. It should not be more than 25,000 per month. Those employees should be participating in RPF and they should be working for us for at least 240 days in the previous year. But in these 3 sectors alone, assessee should have worked for us for at least 150 days in the previous year. To these additional employees, whatever salary is being paid, 30% of that is going to be allowed as a deduction across 3 years. That is ATJJAA. Then coming to ATQQB and ATRRB relating to royalty. Royalty, as soon as you see royalty, the biggest mistake that students make is they straight away come and do this computation. First tax that royalty under IFOS, then come to chapter 6A. Now under chapter 6A, you will have to see, is it royalty relating to books or is it royalty relating to patents? Royalty relating to books will come under ATQQB, royalty relating to patents will come under ATRRB. If it is royalty relating to books, you will see how much is a royalty. You will see, is it lump sum royalty or is it in percentage basis? If it is lump sum royalty, take it as it is. If it is percentage basis, you restrict it to 15%. Okay. So you will, at this stage, you will either have lump sum royalty or you will have percentage royalty, maximum 15%. Now that royalty, if it is earned from outside India, you have to ensure it is repatriated to India within 6 months from the end of the year. Then out of that royalty, you will subtract whatever expenses you have incurred, this net number is what you will get as a deduction under 80QQB, this number or 3 lakhs, whichever is lesser. Okay, so royalty relating to books, you will first restrict it to 15%, but remember, you will restrict it to 15% only the royalty is in percentage basis. Then out of the royalty, you will see how much is repatriated to India within 6 months from the end of the year. From that royalty, you will reduce expenses, whatever net number you get, that or 3 lakh, whichever is lesser, that is what you will get as a deduction under 80QQB. Coming to 80RRB, here we are talking about royalty relating to patents. Here there is no question of restricting to 15%. Here if the royalty is earned from outside India, it has to be repatriated to India within 6 months from the end of the year. From this number, you will reduce expenses, whatever net number you get, this number or 3 lakhs, whichever is lesser, that's going to be allowed under 80RRB. Then coming to the last point under chapter 6A, 10AA. Now 10AA is not a part of chapter 6A as such, but it's a deduction. 10AA deduction you will get only if all these 5 conditions are fulfilled. Condition 1, assessee must have a unit in SEZ. In this unit, assessee must be manufacturing goods or rendering services. Assessee must have commenced his work on or before 31st March 2020. Assessee must have filed ITR within 139(1) due date, and assessee must be following the normal regime. If all these 5 conditions are fulfilled, then for the first 5 years, 100% of the net profits from exports will be allowed as a deduction. Next 5 years, 50% of the net profit from export will be allowed as a deduction. Last 5 years, 50% of whatever is transferred into SEZ reinvestment reserve, whichever is lesser, will be allowed as a deduction. Alright, then we had also worked out questions, if you recall, wherein we had learned that if the export turnover has to be realized into India within 6 months from the end of the previous year, and we had also seen a question wherein export turnover had included freight. So remember, we had excluded the freight. So export turnover should not include the freight. 10AA is extremely important. So I will also give you a revision of the sequence which I taught you. In what sequence are you supposed to compute? Try to recall. You will first check the 5 conditions, right? Then you will check which year are you in. Remember to add 1 when you're computing the number of years. You remember I had given you questions wherein if the question says this is the 5th year, this is the 5th year. But if you're subtracting years and if you're finding which year I am in, you will remember to add a 1. Then you will write the formula. Remember, N into E by T net, alright, into the percentage. Many of you used to forget to write the percentage over here, and then you will show the computation. Alright, so this was your sequence which I taught you in 10AA. First you check the conditions, then you check which year am I in, then you write the formula, and then you compute. Okay. Then after this, coming to assessment procedures, I am very sure many of you have decided to skip, but I am going to be discussing with you some 3 concepts only in assessment procedures. Please do not compromise in these 3 concepts. What are your 139(1) due dates? First of all, 30th November 24 is for those assessees who have any specified domestic or international transaction. Then 31st October 24 is for company assessees. Then all assessees to whom audit is applicable. Then if for the partnership firm audit is applicable, now that partnership firm's partners, whether active partner, whether sleeping partner, for those partners also it's going to be 31st October 24. 31st July 24 will be for all other assessees. 30th November is for assessees who have specified domestic or international transactions, transfer pricing assessees. 31st October 24 is for companies, audit assessees, and if it's a partnership firm for whom audit is applicable, now that firm's partners, whether active partners or sleeping partners, doesn't matter, and 31st July 24 will be for all other assessees. Then coming to the next point, mandatory filing of ITR. It is mandatory to file ITR for which assessees? Number 1, for all company assessees, whether dormant company, whether inactive company, I don't care. Every company you have to file ITR, every firm you have to file ITR. Then individual HUF, AOP, BOY, AGP, when do they have to file ITR? We have 11 situations in which they have to file ITR. Learn it this way, you will just never forget. Number 1, if assessee is GTI, add back 54 series exemptions. If it is more than BL, assessee you have to file ITR. If assessee is ROR and he has a capital asset outside India, I am not saying asset, I am saying capital asset. So if you have a car outside India, this point is not applicable. You should have a capital asset, like you should have shares outside India, or you should have a house outside India. So if you are an ROR with a capital asset outside India, or if you are an ROR who has an agent or a signing authority outside India, if your total deposit in current account is more than 1 crore, total deposit in savings account is at least 50 lakhs, total electricity expense is more than 1 lakh, total foreign travel expense is more than 2 lakhs, if you are carrying on a business and your turnover is more than 60 lakhs, or if you are carrying on a profession and your gross receipts is more than 10 lakhs, or if you're a senior citizen or a super senior citizen with TDS TCS credit at least 50,000, or if you're not a senior citizen or a super senior citizen with TDS TCS credit at least 25,000. There are 11 situations. Even one out of these 11 situations fulfilled, you will mandatorily have to file ITR. Okay, come on, let's run through the list one last time with me. GTI, add back 54 series exemptions more than BEL. Assessees in ROR with capital asset outside India. Assessees ROR with agent outside India. Total deposit in current account more than 1 crore. Total deposit in savings account at least 50 lakhs. Guys, abnormal, at least 50 lakhs. Total electricity expense more than 1 lakh. Total foreign travel expense more than 2 lakhs. Business turnover is more than 60 lakh. Profession gross receipt is more than 10 lakhs. Senior citizen, super senior citizen, TDS TCS credit is at least 50,000, or not a senior citizen or a super senior citizen with TDS TCS credit at least 25,000. I have totally 11 situations. If assessee falls under any of these 11 situations, then assessee you have to file your ITR. But will these 11 situations apply to companies and firms? No. Every company, every firm, irrespective, they have to file ITR. Okay. Now what happens if you file ITR late? Can you do intra-head adjustment? Yes. Can you do inter-head adjustment? Yes. But can you carry forward current year losses? No. But however, even if you filed ITR late, you can still carry forward loss from house property and unabsorbed depreciation. These two you can still carry forward. Okay. Then, can you claim Chapter 6A Part B deductions? Yes. But can you claim Chapter 6A Part C deductions? No. What are the Chapter 6A Part C deductions in your syllabus? We have three, guys. 80JJAA, we have Section 80QQB, and we have Section 80RRB. These are your three Chapter 6A in your syllabus. So, assessee cannot carry forward current year losses. Consequence number 1, Chapter 6A Part C you cannot claim. Then 234F fees you will have to pay. This depends upon the total income. If total income is up to 5 lakhs, you will have to pay 1000 rupees fees. If total income is more than 5 lakhs, you will have to pay 5,000 fees. Then 234A interest you will have to pay at the rate of 1%. 1% of what? 1% of your assessed tax. Assessed tax minus advance tax paid. Assessed tax minus advance tax paid into number of months. Alright, number of months, how will you compute? Even a part of the month you will consider it as full months. Number of months is basically nothing but the period of delay. Like if your due date is 31st October but you filed in November, so 1 month delay. So number of months will be over here number of months of delay. Okay, so 1% of assessed tax minus advance tax paid into number of months. Don't forget to round this off also. You remember rounding off to earlier 100. Then 10AA benefit also you will not get if assessee is filing ITR late. Normal provisions, if assessee is filing ITR late, you cannot follow the normal provisions, which means you will have to follow 115 BAC only. You cannot opt out if assessee files ITR late. So conclusion, if assessee files ITR late, what are the consequences? Consequence number 1, you cannot carry forward current year losses. Consequence number 2, Chapter 6A Part C you cannot enjoy. Consequence number 3, 234F fees you will have to pay. Consequence number 4, 234A interest you will have to pay. Consequence number 5, 10AA you will not be able to enjoy. And consequence number 6, you cannot opt out. You cannot follow normal provisions. You have to follow 115 BAC only. Okay. Then coming to advance tax. Relating to advance tax, I have 2 points, 2 important points. Listen to me carefully. Point number 1, if assessed tax is less than 10,000. We saw assessed tax here also. What do you mean by assessed tax? Assessed tax is nothing but tax liability minus TDS TCS credit. If the assessed tax happens to be less than 10,000, or if assessee is a senior citizen or a super senior citizen not having PGBP, out of these two, if even one situation is applicable, then advance tax will not apply for that particular assessee. Okay, either assessed tax is less than 10,000 or senior citizen, super senior citizen and not having PGBP. Out of these two, if even one situation is applicable, advance tax will not apply. Then 234B, when will 234B interest apply? See, when will 234A interest apply? If assessee files ITR late. When will 234B interest apply? If assessee has paid advance tax even less than 90% of assessed tax. Then only 234B will apply. Now, how do you compute 234B interest? 1% of the same thing, assessed tax minus advance tax paid, same thing only, into months. Now, how many months will this be? This will be from 1st April of the assessment year till when did you file the ITR? Okay, 234B, simple guys. When will it apply? If assessee has paid advance tax even less than 90% of assessed tax, then only 234B will apply. If it is applicable, same 1%, same difference, but number of months will be what? From 1st April of the assessment year till when did you file the ITR for that period. Okay. Then coming to TDS. Under TDS, I have brought 4 concepts to discuss with you over here. First of all, section 194N, which relates to cash withdrawals. If you're withdrawing cash from BCP, then at the time of withdrawal, BCP will deduct tax from you. At what rate depends upon are you a defaulter or are you not a defaulter. Now, defaulter, you're a defaulter means what? Defaulter means for your examination, let's say previous year is 23-24. Now, leave the immediately preceding previous year, see 3 years before that. Leave the immediately preceding previous year, see 3 years before that. All the 3 years, assessee has not filed ITR. It's XXX. All the 3 years he did not file ITR. Do you remember workout batch students? Defaulter, max. You remember that? Yes, guys. So if assessee is a defaulter, then what will you do? Defaulter means what? All the 3 years. Which 3 years? Leave immediately preceding previous year, see 3 years before that. All the 3 years, if he did not file ITR, then he becomes a defaulter. If he is a defaulter, up to 20 lakhs if he is withdrawing cash, no TDS, 20 lakhs to 1 crore, 2% of the excess, more than 1 crore, 5% of the excess. Special point under TDS, we are talking about excess over here in 194N. Generally, other sections we don't talk about excess, but in 194N, we deduct tax on the excess. Okay, but if assessee is not a defaulter, which means even 1 year if he has filed ITR, then if he is withdrawing cash up to 1 crore, no TDS. If he is withdrawing more than 1 crore, then yes, there will be TDS at the rate of 2% of the excess. Okay, so up to 1 crore no TDS, more than 1 crore 2% of the excess. Alright, this is TDS on cash withdrawals 194N. Then comes my next point, 194IB, TDS on rent. For TDS on rent, you have 194I also. But when will 194IB apply? The deductor has to be individual or HUF condition 1, and condition 2 194I is not applicable. Why? Either because it is personal rent or because turnover gross receipt criteria is not applicable. 194I is an R hijack section, no? So preceding previous year turnover should be more than 1 crore, gross receipt should be more than 50 lakh. That criteria is there. So if that criteria is not being met, or if it's a personal rent, then it will come under 194IB. But 194IB will apply only on rent on land and building, not furniture fixtures, not plant and machinery. Also 194IB will apply only if the rent is more than 50,000 per month. I'm talking about monthly rent. If all these conditions are fulfilled, the tenant will deduct tax for the entire year in the last month at what rate? At the rate of 5%. We will not deduct tax every month, only in the last month, only in the month of March. Or if he is vacating the property in December, let's say, then in the month of December. So in the last month or in the month in which he is vacating the property, in that month only you will compute this TDS, only if the monthly rent is more than 50,000 at the rate of 5% you will compute, but you will enter into this section only if 194I is not applicable. Why is 194I not applicable? Either because it is personal rent or because turnover gross receipt criteria is not fulfilled. And do remember, this section is only for individual and HUFs, and the deductor has to be a resident also over here. Okay, so this was section 194IB. Then coming to 194C, I am just discussing 2 important points from 194C. Let's say there are 2 people over here. We have Netflix on one side and we have Balaji Telefilms on another side, which is a producer. Alright, now Netflix is giving all specifications to Balaji Telefilms that how should the movie be. The movie should have, the movie should be shot in this place. This should be the story of the movie. This is the script of the movie. These are the actors, these are the actresses. The whole specifications is given by Netflix to Balaji Telefilms. Balaji Telefilms, their work is just to produce the movie according to these specifications and then give the movie to Netflix. In fact, even the copyright will be given to Netflix. If all these conditions are fulfilled, this will be a works contract and it will fit under 194C. Specifications are given, copyright is also transferred, 194C will apply. Then, if in 194C, if you remember, even carriage is covered, guys. Right, A, B, C, C, important point, remember. So, it's one of the C's, one C is for catering, another C is for carriage. So, even carriage is fitting in 194C. But 194C will not apply if the deductee happens to be in the business of plying, hiring, leasing goods carriages and he does not have more than 10 goods carriages and either PAN or Aadhaar, at least one thing he is furnishing and he is given a certificate in this regard. If all these conditions are fulfilled, 194C itself will not apply. What are the conditions? The deductee, he is in the business of plying, hiring, leasing goods carriages. He does not have more than 10 goods carriages. Same point, where else do you have? 44AE, there also assessee should not have more than 10 goods carriages. PAN, Aadhaar, at least one deductee is giving and certificate is given in this regard. If all these conditions are fulfilled, 194C will not apply. Okay, but what if he is not giving PAN or Aadhaar? Neither he is giving, guys. He is neither giving PAN nor he is giving Aadhaar. Then in that case, this exception will not apply. 194C will apply. But if he is not giving PAN Aadhaar, then 206AA will also apply. So the TDS rate will become 20%. Okay, if he is not giving PAN Aadhaar, then this exception will not apply because this condition is not fulfilled. So which means 194C will apply. But because deductee is not giving PAN Aadhaar, 206AA will also apply. So 194C plus 206AA. Remember, we had created one chart for this. These two sections put together, the TDS rate will become 20% for in this scenario. Okay, then comes 206C1G from TCS relating to overseas remittance and overseas travel package. Very important. Overseas remittance, if the remittance is relating to ATE loan up to 7 lakh, no TCS. More than 7 lakh on the excess, 0.5% TCS. If the remittance is relating to education or medical treatment outside India, then up to 7 lakh, no TCS. More than 7 lakh on the excess, 5%. If the remittance is relating to any other purpose, up to 7 lakh, no TCS. More than 7 lakh, up to 30th September 23 on the excess, 5%, and after 30th September 23 on the excess, 20%. This is very important, guys. Please remember, when I say 7 lakh, all the 7 lakhs are put together one 7 lakh limit. You don't have separate limit for all three. It's an aggregate 7 lakh limit. So ATE loan up to 7 lakh, no TCS. More than 7 lakh on the excess, 0.5%. Education or medical treatment up to 7 lakh, no TCS. More than 7 lakh on the excess, 5%. Any other purpose up to 7 lakh, no TCS. More than 7 lakh up to 30th September 23 on the excess, 5%. After that, 20%. Then you have overseas travel package. Travel package means you're going to make my trip, for example, and you're not only buying a ticket to Dubai, you're also buying hotel package. So it's a tour package. You're not buying just flight tickets. You're also buying from them hotel stay package as well. So if it's an overseas travel package and overseas tour package, up to 30th September 23, the TCS rate is 5%. More than after 30th September 23, up to 7 lakh, the TCS rate is 5%. More than 7 lakh, the TCS rate is 20%. But do you have 7 lakhs exemption here? Am I saying up to 7 lakh, no TCS? No. Whether less than 7 lakh, whether more than 7 lakh, you will have TCS. Just that before 30th September 23 it was 5%, and after that up to 7 lakh it is same 5%, but more than 7 lakh it is 20%. Here you will have a separate 7 lakh limit, here separate 7 lakh limit, but remittance 7 lakh limit will be shared between all the three. And also remember, if any payment is made through international credit card, 206C1G will not apply. Then 2 children limit will apply in how many places in your syllabus? In your syllabus, 2 children limit is applicable only in 4 places. Leave travel concession, children education allowance, children hostel allowance, tuition fees, section 80C, minor child clubbing, there is no 2 children limit. Okay, tuition fees, 80C, children hostel allowance, children education allowance, and LTC. Then comes my AMT discussion. Oh, this is very important, guys. AMT. Assessee should be either having 10AA or 35AD or Chapter 6A Part C. See, listen, when will you think about AMT? Under the normal regime, when you are computing tax, your tax computation is not complete till you have thought about AMT. But AMT will not always apply. There are 2 conditions. Only if both the conditions are fulfilled, only then you will do AMT computation. So assessee should be either having 10AA or 35AD or Chapter 6A Part C. Any one at least assessee must be having. And either the assessee will be individual HUF, AOP, BOY, AJP with total income of more than 20 lakh, or assessee can be firm LLP, but assessee should not be company. Okay, so if assessee is individual HUF, AOP, BOY, AJP, then assessee's total income should be more than 20 lakhs. What do you mean by total income? Total income here means total income, add back 10AA tax holiday, add back 35AD deduction, add back Chapter 6A Part C, then on the 35AD deduction, claim depreciation on the 35AD assets. This net number, totally 4 line items, guys. This will be your total income. Total income, add back 10AA, add back 35AD, add back Chapter 6A Part C, subtract depreciation on 35AD assets. This is going to be your total income for the purpose of AMT. Alright, so this number should be more than 20 lakhs. So two conditions, either assessee must be having 10 AA or 35 AD or chapter 6A part C, at least one. And second condition is that if assessee is individual HUF, AOP, BOY, AJP, his total income should be more than 20 lakhs. If both the conditions are fulfilled, only then AMT will apply. AMT will be at the rate of 18.5%. Remember, you're supposed to pay normal income tax or AMT, whichever is higher. If AMT is higher, you will pay AMT, but if you are paying AMT, you will have AMT credit, which will have a life of 15 years. Alright, so this was about your AMT discussion. And last point, if your assessee files ITR within 139(1) due date, he can either follow 115 BSE or he can opt out and follow the normal regime. But if assessee files ITR late, he has to stay within 115 BSE only. Alright guys, so these were 50 top adjustments which I think you should be knowing if you are stepping into the examination hall. In this discussion, if you happened to come across a new adjustment, don't be disappointed that oh, I'm still learning. Even in the last 1.5 days, I still don't know this. Don't be disappointed. Instead, be happy, be proud of the fact that you were able to see this before your examination. All the best guys, that's it from my side. Go out there and rock the examination. Bye-bye.